With us here on Ask Udayan, the show where we answer all your stock market related queries with our global business editor Udayan Mukherjee. Let's bring you the number on your screen once again just to remind you, and you can simply send in a text or a video on our WhatsApp and we will take a few of those queries every Wednesday. Here's our first viewer query today. Our first question is from Tanveer Mistry of Ratnagiri, and this one's on Thermax.
This is Tanveer Mistry from Ratnagiri. Thermax has recently touched a 52-week high. I have purchased it at around 850 to 900 level about 2 years back. Is there further chance for appreciation, or is it a good time to exit from the stock?
No, I would not recommend a very hasty exit from Thermax. You've made a lot of money on that company over the last couple of years, and the stock has actually gone up some 65% in the last 1 year. So it's in a bit of a tear. But I think there's a good reason for it, because this is a classic example of a company which is reinventing itself completely. You know, Thermax used to be a boring boiler maker. But unlike BHEL, which is still stuck to thermal power as its main client group, and thermal power is not growing as an industry, and therefore the demand for boilers is not growing, Thermax has cleverly tried to orchestrate a complete turnaround of its business strategy by focusing on clean water, clean air and clean energy. I mean, that is what the company is trying to do now, and it's no longer a boring boiler maker. And if you look at some of these new initiatives that they're doing, which is the waste to heat recovery plants, enormous possibility going forward. I think in a sense it's a clean energy play now, and that's what the market is quite excited about, because it has always been a good management and a good company, but now with the focus on clean fuels or clean energy and water and air as its thrust area, I think the possibilities of growth have gone up multifold, and you can already see it in the recent numbers for Thermax. The only problem is that, as you said correctly, the stock has gone up quite a lot. It's no longer at 900, it's at 2200. So given that the market is going through a turbulent phase and that the stock is already trading at a P multiple of 45, you might see periods of pullback in Thermax. You should be prepared for that, because it's no longer a cheap stock. But I think otherwise, for a 3 to 5 year kind of horizon, given what the management is trying to do, the bigger rewards probably lie in remaining invested, having gotten at such a good price point for you.
All right, Manish Sharma has written in from Jamnagar, and he holds Infosys, so very topical at that. Let's hear out really where he's at with his investment.
Hi Udayan, I'm a big fan of you. I want to know about Infosys. I have bought 100 shares at the rate of 1,322. Should I hold or exit? Thank you.
Well, your price is good, entry price, and you're not in losses like a lot of recent investors in Infosys may be, because the stock has corrected quite a bit. I think this current earnings communication has created a little bit of discomfort among investors about whether the IT story is still good for the next 1 or 2 years, or should one be booking profits and checking out of that sector. Because one thing is clear, attrition is a major problem for the sector right now, and margins are coming under pressure therefore, because the wage hikes will have to be much more aggressive going forward. Infosys's EBIT margin guidance of 21 to 23% for next year is also lower than expectations. And given that the entire sector, and Infosys particularly, saw such a big valuation expansion, you know, the stocks which used to trade at 20p multiple went up to 32, 33p multiple over this period of 12-18 months. That kind of valuation expansion needs constant earnings upgrades to justify itself, and that has not come through this time around from Infosys. In fact, most brokerages would have cut earnings estimates by 5 to 7% after the current quarter. So you can sense what is going on, but I think the stock has corrected quite a bit from 1900 to 1500, and between 15 and 1600. And if this correction continues, very soon, it's not there yet, you will find the stock when it comes to say 1400, 1450 levels. If it does that, another 100 rupees from here, the stock will be trading at 20 times FY24 earnings. And that, I think, given the quality of the management and the business, is not a bad price point to be looking at that stock again. So I understand the current nervousness, but after the recent correction, I think it will soon be approaching attractive levels, and I wouldn't advocate you to panic about Infosys now.
Okay, C.R. Pagaria has a query on VGuard. He writes in from Bangalore.
I have 1,000 shares of VGuard at an average purchase price of rupees 240. Please suggest me, can I hold for 2 years?
Well, you could, but don't expect the stock to be a rocket. Your acquisition price is 240, which is on the higher side. We are a little bit below that, but it's not as scary as last month when the stock plunged to 182, if I'm not mistaken. I mean, that would have been scary for you. But the stock might consolidate for a while, but I don't think you will make a lot of money in the next couple of years from your acquisition price of 240. Sorry about saying that, because the problem with VGuard is that its core business, or its largest business, which is stabilizers, is no longer a segment which is growing very fast, because the quality of power in India has improved such a lot that at some point all of us had stabilizers in our homes. But these days the need for a stabilizer has gone down significantly. VGuard knows that, and therefore it is trying to get into consumer durables, consumer appliances, consumer electronics, kitchen appliances, because those are A, high margin businesses, and B, they're not quite the boring flat business of stabilizers. But the problem is that it has got low margins in the appliances business, and when you go out to a shop, you can identify with brands like Havells or Crompton, but VGuard in the appliances segment is not such a high recall brand yet. Maybe they will get there. So if you have to buy consumer electronics or appliances, I think the better stocks could still be Havells or Crompton consumer rather than VGuard. So it'll probably need some more time to get entrenched in the electronics business, and therefore I would say that the stock will probably just about amble along from your purchase price and not generate very high returns over the next couple of years. I could be wrong, but that's my assessment.
Kalpesh Kacharia has a query. Now Kalpesh is from Surat and he has a query on Deepak Nitrite. Let's listen it.
Hi Udayan sir, I am Kalpesh Kacharia from Surat. I am holding Deepak Nitrite share at the rate 1,500. Should I hold or exit? And if the dollar go up, so it's a negative impact upon the chemical sector. So now what is the view upon Deepak Nitrite? Should I hold or exit, or can I buy more if fall down correction?
Well, Deepak Nitrite is a good company, as you well know, and you bought it earlier. The stock doubled from your acquisition price to 3,000, and then it took such a big 40% correction all the way down to 1,800. It's no longer there. It's bounced back since, but nowhere close to that peak of 3,000. I think you will need to be patient with Deepak Nitrite right now, because the thing to understand is that it had a very good phase when its core business, phenol, which is more than half of its revenues, was doing very well. But my sense is that phenol, that story has peaked. Prices have peaked in phenol, and I don't think Deepak Nitrite will make a lot of money from that business. It's still a good company. It understands that phenol is cyclical, and maybe the cyclical peak is behind it, or we are quite there yet. And therefore, for Deepak Nitrite to go back to 3,000 and to go higher from there, what needs to happen is that the share of specialty and fine chemicals in their overall portfolio has to go higher. Now they are doing capex aggressively, and I think they are cognizant of the fact that they need to up their ratio of fine chemicals so that the margin profile increases and they can reduce the volatility which comes from phenol being such a large part of their business. This will take some time, particularly because this is a stock which has gone up 15 times in the last 5 years, and that too after such a big correction. So this has been a multi-bagger, but having been such a multi-bagger, I think now it needs to consolidate, and this is the process of consolidation that you're witnessing at this point in time. So for longer term investors, they should not get too pessimistic, but I think they will now need to realign themselves for less spectacular returns that they've got used to from Deepak Nitrite, at least for the next couple of years, till that capex comes through and more specialty chemicals flow through to their revenue stream. So I would not despair, but I would temper my stock market, stock return expectations from what one has seen in the past and what one needs to align oneself to for the next couple of years at least.